I'm going to go over just an introduction to what we call the QBI deduction. So this is pretty involved. This will be just kind of some basics. It's called the qualified business income deduction. So that's the first thing you need to focus on is what is qualified business income? And then there are some other things, some other questions I have here. What type of deduction is it for or from? What's the amount? What do we base it off of? Those kinds of things. So the first thing I want you to know is that the QBI deduction is relatively new. It came into play with the TCJA Tax Cuts and Jobs Act of 2017. That law was passed in December 2017. QBI deduction was in play for the first time in 2018. And as the law was written, that deduction would only be in place from 2017, or excuse me, 2018 through 2025. Well, I'm making this video in 2025. So what's going to happen at the end of the year? We don't know for sure. I have a feeling Congress is going to do something to extend this deduction, but we don't know if it'll be the exact same or not. But we still have to know it for now, and then we'll tweak it a little bit if we need to after. I'm sure if Congress makes a decision, it'll come rolling in around December 30th of 2025, just in time for us to figure out what's going on in 2026. So first, I want you to know why this deduction came about. With TCJA, one of the main purposes of it is Congress wanted to reduce corporate income taxes from a flat rate of 35%, and they brought it all the way down to 21% flat rate. But think of all the other business entity types in the US. We have partnerships, S corps, sole proprietorships. So if you're a mom and pop small business and you're looking at Exxon get a 35 all the way down to 21% tax rate reduction, you want one too, right? Heck yeah, you do. So this was Congress's answer to that. Rather than just remember an individual going through those pass-through entities like I just mentioned, they don't have just a single flat rate. They pay taxes on that business at whatever their personal rate is. It passes through to the individual. So if I'm in the 10% bracket, it's 10%. If I'm in the 37%, it's 37%. So it wasn't as easy as what they could do with the corporate rates. So they said, okay, we'll take your qualified business income, which I'll go into in just a second. But what I want you to think of generally in your head is your net income from a business. So you own a bakery, it's your revenues minus your expenses. It's not quite that easy, but just to give you a general idea to start with. You take your qualified net income, qualified business income, and Congress said, we're going to give you a 20% deduction on that. Okay, sounds easy enough. So the amount 20% of whatever this qualified business income is. And what type of deduction is this? Well, this one's kind of strange because normally we say business deductions are for AGI deductions. This one is a from AGI deduction. So now that should get your wheels turning and you should be thinking, does that mean I have to itemize? Is it on Schedule A with all of those other from AGI deductions? Nope. Luckily, you won't find it on Schedule A because a lot of people don't file Schedule A anyway. Wouldn't do you any good here. So although it's a from AGI deduction, it is separate from your Schedule A deductions. You'll see it if you look at your 1040 on page 1, you will see it below the AGI, but before you get to taxable income. And it's a standalone. So even if you don't itemize, you can still take the QBI deduction. That's good news. Okay, so let's talk about this 20%. 20% of what? It's 20% of your base income, which is QBI. Okay, so I've got just a little problem. Again, this is just an intro video. We will go deeper into this later, but I've got a basic problem of, I'll say Ramona, or it might be Simone that I had in your notes. She owns a small business and her qualified business income was $230,000 from that small business. I said you can think of this as roughly like Schedule C net income if it was a sole proprietorship, revenues minus expenses. You would need to make a couple of adjustments. One big one is you would take out any self-employment taxes because that's already getting a deduction on your Schedule 1, your 4 AGI deductions. So we'll just call it QBI for now. And then we compare it to something called MTI, modified taxable income. So I want you to stop for just a second, stop the video, and without even knowing what these mean, see if you can generally think about what would be the difference between QBI and MTI. So QBI is related just to this business in question, the qualified business. But MTI, taxable income, that relates to a person or a couple, if they're married filing jointly, all of their income. So say I'm Simone, I'm the one with the business, but I have a spouse and my spouse has some income also. Or I could be single and I have other types of income, interest income, dividend income, whatever. So modified taxable income encompasses more than just the business. So the intro rule to how we figure out what this QBI deduction is we take the lesser of either QBI or MTI. So what I like to say is that 20% of whatever that qualified business income is, that's the maximum deduction you can ever take. But sometimes it might be limited by MTI. Not always. In this case, it's not limited. My QBI deduction, 20% of that would be what, 46,000? Well, percent, 46,000. And 20% of this would be 50,000. And you have to remember, we take the lesser, which is why I like to say this is the max. The most you're ever going to get is 20% of that QBI. But sometimes your modified taxable income might actually be lower. Let's pretend I'm just single and I only own this business. My taxable income is going to go down, right? Because I either am going to get to take the standard deduction or the itemized deductions, which is going to pull that other income down. And in that case, MTI would be lower. So 20% max, MTI, if it's lesser, then you take 20% of that. And that's all I'm going to do for this video for our just baby introduction of it.